Hello, what's going on? Samuel Joseph here for Elevate Forex, and so glad you could join me today. At the end of this video, you should be able to know what the Forex markets are and how to trade in them. You should be able to know some key terminologies that are involved with trading, and you should also know how to set up your trade account. So let's jump right into it. First of all, what is Forex? Forex is an abbreviation for foreign exchange. And let's give a hypothetical example. Say, for instance, you ever wanted to travel out of the country and you had your local currency and you needed to exchange it. I'll be using the naira and the dollar for this example, right? So let's say you had 100,000 naira and you exchanged it to the dollar for 100,000 naira to give you $100. Let's say the exchange rate was pegged at 1,000 naira per dollar. So a couple of days after, you decided not to travel anymore, but instead to convert that $100 back into naira, right? And you went to the bank. So when you go to the bank, you discover that the exchange rate had moved from 1,000 naira per dollar to 1,500 per dollar, and you went ahead to exchange those funds. You'd be making a profit of over 50,000 naira. Why? Because the exchange rate had changed. So what exactly happened was you held on to a currency pair while the exchange rate moved. So if it moved in your favor, that is the exchange rate increased, that means you'd make a profit. However, if the exchange rate had reduced from 1,000 naira per dollar to, let's say, 900 naira per dollar, then you would have been holding a loss and your 100,000 would have become 90,000 naira. I hope that example hits home. Well, basically that's what Forex trading is. It's holding on to a particular currency, whatever it is. Could be the euro, be the dollar, could be the naira. Naira is a native currency for Nigeria. That's my country, right? So that's basically what Forex trading is, holding on to a particular currency pair while the exchange rate moves. Now, to do this, you are going to need so many things, and there are so many participants involved in trading. So that's what's going to lead me now to discuss about the market participants. So how many people trade Forex? Now, there are so many people who trade Forex, from hedge funds, large institutions, central banks, and speculators, right? So every individual who's jumping into the Forex funds, you're not sovereign wealth like you and me, you're a speculator in the Forex markets, right? And the market itself has a very huge trading volume, about $6 to $7 trillion per day. That's their market cap daily, right? So there's every opportunity for you to make a profit from trading. And we have other reasons why these huge companies or central banks or hedge funds, as the case may be, these different market participants, they have various reasons for getting involved in the Forex markets. But we're talking about me and you. How can you make money from trading the Forex markets? Okay, so we talked about the market participants, right? And we said you who's jumping into Forex trading, you'll be referred to as a speculator, right? So what are the things you are going to need to be able to trade Forex? First of all, you need a charting software. And second of all, you need a broker. I'm going to go ahead and explain what those two terminologies are. Now, a charting software is more like what you see on your screen right here. This is TradingView. It's a charting software. We have several others. We have MetaTrader 4, MetaTrader 5, CTrader. There's so many of them. And I prefer making use of MetaTrader 4, not 5. I prefer making use of MetaTrader 4, and I also do most of my analysis on TradingView. So I'm going to be showing you exactly how I utilize these tools for my trading. And the second thing you're going to be needing to trade is a broker. Now, who is a broker? A broker basically is that institution that provides you with the quotes, let's say provides you with the prices and provides you the opportunity to deposit your capital and actually trade. Now, let me explain this. For you to get involved in the market, you first need the charting software to be able to see where price is. Take, for instance, you want to buy a currency pair, but you don't know exactly where that currency is trading at. You understand? Like, you don't know where the dollar is exchanging. You don't know how much the dollar is exchanging for the pound for. So you need a charting software so you can be able to look at price, see where price is, see where it's going. We'll talk a lot about that later. And you need a broker. Now, the work of your broker is to accept your deposit, first of all. they keep your money safe. They offer to you something called leverage, right? We'll talk more about that when we look at trading terminologies. And they help you to execute your orders in the markets. And that's why it's quite important to select the right broker for your trading. I'll leave a link in the description of this video to the exact brokers we use. There are several of them, and you can choose a broker depending on your trading style or depending on the kind of trader that you are. You could be a day trader, you could be a swing trader, you could be a scalper, you can be an intraday trader, whatever the case may be. So I'll explain each and every role that I've mentioned. Okay, let's start from the very top. Let's say you are a swing trader. That means you open a position and you open a trade and you hold that trade for as long as possible. It could be a year, it could be 2 years, it could be 6 months. What you're doing is referred to as swing trading. And you could be an intraday trader. That is, you hold a position open, you hold a trade open for a couple of minutes up to, basically for a couple of hours. That makes you an intraday trader. Maybe you open at the open of the market, you open a trade at the open of the market and you close when that market session is closing, or you could hold a trade throughout the entire day. That makes you a day trader. And if you're a scalper, you open a trade for a couple of minutes to maybe an hour max. So depending on your style of trading, there are different brokers that you could use, and there'll be some that will be quite suited to your model of trading or your method of trading. And we'll talk about brokers more in a subsequent video. All right, so let's head right into it. Now that you know what you need exactly to get started trading, you need a charting software like we said, and you also need a broker. Once you have those two things set in place, then you can go ahead and create an account with your broker and connect that account you've created to your charting software. So all your analysis, looking at price, trying to see if price is going up or coming down, will be done on your charting software. And also your execution would also be carried out in that charting software, because once it's connected to your broker, you'll be able to carry out those trades effectively. You'll be able to execute an order. So let's now jump into some of these terminologies so that you understand in depth what they mean. I'll be using the screen. So let's start with the very first terminology you're going to come across as a trader. You know, a lot of people make fun of this terminology a lot, and I'm starting off with this particular one. It's called your stop loss. I'll explain what stop loss is. I'll explain what a take profit is. And we'll talk about these are called your market orders, right? Your stop loss, your take profit, instant execution. And then we'll also talk about limit orders, limit orders, and we'll talk about stop orders. Okay, these are the first terminologies we'll look at. So what then is a stop loss and what is take profit? Now when we talk about stop loss, take for instance you're entering a trade. Now one of the most important things that I have to say before we even proceed further in this video is you have to take trading as a business. There are a lot of people who have made trading seem like it's a get-rich-quick scheme, right? You just jump in, you flip an account from $100 to $1 million in a day. It's possible, right? Not necessarily $1 million, but it's possible you do that. Well, how consistent will that be? So it's better to develop the right trading skill set and the mindset from the early stages of your trading so that it doesn't become a challenge to you later on. All right. So stop loss is one of the most important orders that I make use of while trading. Now, what does a stop loss do? Just like the name implies, it prevents you from accruing more losses while you are trading. That's a stop loss. So take, for instance, you enter a trade at, let's say you're trading GBP USD at the price of 1.21800, right? And you're expecting price to move in your favor. Let's say you're expecting price to move a certain amount of steps, right? There's what we call those steps. It's referred to as pips. Now, let's say you're expecting price to move a certain amount of steps in the market, but you opened your price at 1.21800, right? So your stop loss is that order that explains to you or that exits you from the market if the market is going against your direction. Let's say you're expecting price to push up, the value of the exchange rate to increase, however it was decreasing. You need to get out at some point. Your stop loss order is what causes that to happen. Once price hits your stop loss, you are taken out of the market, and it prevents you from accruing more losses. Consequently, take profit is what a lot of people like to hear. Take profit refers to, it's still a method of exiting the market when price has moved in your direction and you are satisfied with the amount of profit you've made off the market. Then you set a take profit. Now there are certain levels you should set your stop loss and your take profits depending on your analysis of the charts. We explain that in future videos. So the next thing we're going to be looking at would be the instant execution. So an instant execution is just an order to execute price at its current position. For instance, the market is trading at 1.21800. If you're going to get involved in the market and you want an instant execution, what you're saying is, I want to go ahead and sell at this price, or I want to go ahead and buy at this price, right? So when you're doing that, you utilize an instant execution. So let's use GBP USD for instance. Let's say you have price ranging and you're looking at the price of 1.21800 to get involved in the market. Once price hits this price line, 1.21800, you go ahead and get involved in a buy and your trade would be executed. Consequently, if you're looking to sell, you do the same thing. Instead of hitting a buy, this time around, you're going to be hitting a sell. And you have price move, you have your order executed and price move in whatever direction it wants to go. And always remember to utilize your take profits and your stop loss. It helps you protect your account, and that's a proper trading habit. All right. So the next thing we're going to be looking at will be limit orders. What do we mean by a limit order? Now, a limit order is an instruction to buy or sell below or above the current price. Let me break that down. Let's say, for instance, you're looking at a limit order. It's divided into two. We have a buy limit and we have a sell limit. So if you're looking to get involved in the buy limit, what you're trying to say is price hasn't gotten to that price level yet. Let's say this is the price level you're looking to get involved for a buy, and price hasn't gotten there yet. So let's say it's a 1.21400 and you want to buy at this price. However, price hasn't gotten there yet. It's above that area. So what you do is you set a buy limit that as price is coming down, once it gets to the price in which you want to have your order executed, you're expecting it to reverse. Now, most people who use a buy limit are people who are expecting to buy the market and price hasn't gotten to their buy orders yet. That's when you use a buy limit. Consequently, if price is trending upwards and you are expecting a sell, you'd like to utilize a sell limit, meaning price hasn't gotten to that level yet, but once price gets to the area you're looking to sell from, you're expecting an instant execution for a sell, right? So you use a limit order. Instead of sitting and looking at the charts all day and waiting for price to get there, you utilize a sell limit so that once price pushes to that area, you're expected to get involved in a sell. That's for limit orders, buy limit and sell limit, as the case may be. Okay, so let's say we've looked at, so far so good, we've looked at a few terminologies. We've looked at the buy limits, we've looked at the sell limits, we've looked at instant execution. You know what a stop loss is, and you know what take profit is. These are all orders to get involved with the market. Okay, so now let's look at the last set of instructions we'll be looking at. That's stop orders. What does a stop order mean? Now, instead of having price reverse in an L-shaped manner like with the limit orders, a stop order is an instruction for price to pick your order and keep going in the direction it is trading in. So for instance, let's say you are expecting price to drop to, let's say price has been dropping, right? And you are expecting it to drop to a certain level or to keep dropping further. And you are looking at an area and you expect that once price gets there, price should break that area and keep dropping. What you like to set is what we call a sell stop. Just like the limit orders, the stop orders are divided into two as well: the buy stops and sell stops. All All right. So let's say you are expecting price to trigger your order and continue on its way down. You'll be setting up a sell stop. Consequently, if you're expecting a market that has been trending upward to pick up your order and keep trending to the upside, you'd be using a buy stop, right? They are really simple. So let's do a quick recap of everything we've talked about so far. So first of all, we talked about stop loss. I said this is one of the important market orders we have, stop loss. And how would you use a stop loss? For instance, you open a trade, you're involved in a trade, and you don't want to lose more than a certain amount of money. Take, for instance, you fund your trading accounts with $1,000 and you want to enter into a trade, one trade, and you don't want to lose more than $10 on that trade, right? You go ahead and you set an order referred to as a stop loss on that trade you are taking, which means as you've gotten involved in the market, you want the market to move in a certain direction. However, if you're wrong with your analysis, you want to not lose more than a certain amount of money. Subsequently, when we talk about risk management, I'll show you exactly how to calculate your stop loss, how to know exactly the amount of money you are risking per single trades you place in the market. So stay tuned. So the next thing we talked about was your take profit. Just as the name implies, you're looking to get out of the market after gathering some amount of money that you're comfortable with. So let's say, again, you have $1,000 in your trade account and you got involved in a trade, and let's say the market has moved in your favor. You bought GBP USD and the market has moved in your favor, and you're looking to take out, say, about $200. Let's say the market moved 2,000 steps in your direction and you made about $200 profit. Steps are referred to as pips. I'm just using the most basic terminology so that we can get acquainted to it before we move on, right? So let's say the market moved 2,000 pips or 2,000 steps in your favor and you made about $200 profit. The order you would use to take that amount of money or to stop that trade from running would be a take profit. So when price hits your take profit, it will exit you from that particular trade and you would have your balance increase, right? So let's look at the next thing, which is the instant execution. Like I said, you want to use an instant execution when you're looking to get involved in the market immediately. Let's say you want to buy on the spot. Price is exactly where you want it to be and you want to immediately get involved in the market. You use an instant buy or an instant sell, as the case may be. And also you want to exit the trade without using a take profit or price hitting your stop loss. You can also use an instant execution. What do? You go ahead, open that trade you're on, and you click on close. It's an instant execution and you get exited from the market as well. How about limit orders? Take, for instance, you're expecting price to reach a certain price point. Like I said earlier on, the markets are dropping and you expect price to stop around here and reverse. What you're going to be using is a limit order. Limit orders are used mostly by reverse traders. That's traders that are expecting a particular trend to reverse, right? Let's say the market is dropping and you expect it to reverse at a particular point. You would like to use a buy limit. So once price hits your buy limit order, it will get you triggered in the market and you see price move in the direction you expect it to go. Of course, you have to do your analysis. And also, let's say you're using a sell limit. That means the market is rising, like we said, and it's gotten to a point where you expect it to sell from. What happens is you set a limit order. Once price hits your sell limit, you expect to see it turn in the opposite direction. That is what you are anticipating. Doesn't mean that's what's necessarily going to happen, but that is the kind of order you want to execute in the market. You are expecting that price is going to reverse. You want to sell. The market was buying. You want price to hit your limit order and then reverse. That's when you use a limit order. Now for the stop orders, let's say, for instance, you're trading the news. We'll talk more about news trading as we proceed. But news events usually come with a lot of movements. We say the markets move heavily during news events. You go ahead and see maybe very long movements like this. If you're using the candlestick, we say you see a very long candlestick. Or if you are using the line chart, you see a very long line, you know. And so let's say you want to get involved in that move as well. You're expecting the market to sell after a news event is about to come out. Let's say NFP, for instance. We'll explain more of these news events in subsequent videos. But you're expecting the market to move with so much speed and you want to get involved in the market. This is a way you can use a sell a stop order. So what you want to do is you go ahead and place maybe a sell stop if you're anticipating the market to sell. And let's say the next thing you know is maybe the news event comes out and then price moves heavily. It will trigger your sell stop, and it will keep moving in the direction you anticipate that move to occur. So a sell stop is an order for the market to continue moving in the direction you anticipated, or the direction it has been moving in. And also, let's say for instance, you expect the market to keep selling. It's already in a selling trend, it's falling, and you expect it to keep falling. What you would likely use to execute an order to get involved in the market is a sell order, a sell stop. And consequently, if the market is in an uptrend, it's moving upward, right, and you want to get involved in the market and you expect it to continue going up, you'd like to utilize a buy stop. These are ways you can use these orders in the market. So far so good. We've talked about your stop loss, your take profit, instant execution, limit orders, and stop orders. There's also one very important terminology we need to talk about, and it has to deal with your broker. Now, I'll go ahead and add to the terminologies we have on the screen already. And the first thing we would like to look at, we'll call it spread. Spread, spread. Then we have, of course, you know what buy is and you know what sell is. So another terminology that is similar to that would be the ask and the bid. So we're looking at spread, ask, and bid. Okay. Now, what is spread? I'm going to be using an example to explain this one. Have you ever walked into a bank and you see their FX department or the FX section of the bank, and you notice that price is quoted in two forms? You see the first one clearly written we buy, and you look at the second column, it's clearly written we sell. Then you have various currencies, aligned following the we buy, we sell. So what that means is your bank is willing to buy a particular currency from you at a particular amount. Say for instance, you have, I'll use the Naira again, the Naira to the dollar. Let's say the price quoted on that board is we buy for the Naira, you see maybe 1,000 Naira per dollar. And then you look at the we sell column, you have a price quoted at maybe let's say 1,200 per dollar. What that simply means is the price in which you're looking to buy at is different from the price in which the bank is going to sell to you. In this case, let's bring back that example home, and then we'll be dealing with the broker. The spread refers to the difference between the ask and the bid. Okay, without using those terminologies, the spread refers to the difference in price between how much your broker, or the difference in price from what your broker is willing to sell to you and the amount you are offering for that currency. Let me explain it this way. You have a currency quote, right? Let's say you have a currency quote. The first thing you will see is the currency pair. Let's say you see Euro USD. The next thing you see is the asking price. Maybe Euro USD, you see something like 1.02897. And then the next thing you see just right beside it would be the bid. Maybe you see it at 1.02899. 1.02899, sorry, 02899. What that means is your broker is going to buy from you at this price, but we sell to you at this price. Now the difference between these two is the spread. Now let's go ahead and look at the difference between these two. We have 1.028789 and 1.02899. If we do little maths, we would have let's do this together. You would have 899 subtracting 789. So that's about 111. Yes, that's 11 pips, an 11 pip spread. It's quite wide. You know how we got that, right? If you just do the subtraction, you're going to get it. 9 take away 9, we have 0. 9 take away 8, 1. 8 take away 7, 1. That's 11. That's 110. Let's call it 110 instead. So let's say that amount is now what your broker keeps as their gain. Of course, they're not a charity organization. They are into the business to also make a profit for themselves. So when you have a spread, usually it refers to the profit your broker is making from you utilizing their services. They sell to you at one price and they buy from you at another price that is separate from how much they sold to you in the first place. That difference in prices is the profits that they are making for themselves for offering you that service. That's what we refer to as the spread. So if you're choosing a broker, you'd like to look out for a broker with lower spreads so that you could be more profitable with your trading as well. Like I said, I'll leave a link to the brokers we use in the description of this video. The next is the ask. And I used this terminology when I was explaining earlier on. The ask simply refers to the price in which your broker is willing to buy from you, while the bid refers to the price you're willing to buy from your broker. Now, when you are entering a trade, you are either buying from your broker or you're selling to your broker. Your broker executes these orders. It doesn't necessarily mean they're taking the opposite side of your trade. When we talk more about brokers, I'll explain to you the different kinds and how they fulfill these orders. We have the dealing desk brokers, non-dealing desk, STP, ECN. There's a myriad of ways that your broker fulfills your order. So we'll deal with that in a separate video, all right? But these are just some basic terminologies you need to get acquainted with if you're going to be trading the Forex markets. So the last thing we're going to look at right now is how to set up your own trade account so you could get started instantly, right? So let's jump right in. Or before we jump right into it, let's take a quick recap of what we've looked at so far. We started off by introducing ourselves to the Forex markets. We defined what Forex meant. We said it's an acronym for foreign exchange. We gave an example of, a Forex transaction, holding on to a currency pair while the exchange rate fluctuates. So you could either make a profit or a loss depending on if you were right or wrong while you were, taking that trade. That's what Forex basically means. Then we went ahead to describe or to list out some of the market participants that are involved in the Forex markets. We said we have central banks, we have several sovereign wealths, we have hedge funds, large multinationals, and so on and so forth. And then we said we also have speculators, and you who's watching this course right now is a speculator just like me. Yes, we also make up the vast majority of the Forex markets. Those are those participants that are involved. And the next thing we talked about was the things you need to get started trading. We said, first of all, you need a charting software. And I went ahead to list out a few. I said we have TradingView, we have MetaTrader 4, MetaTrader 5, we have CTrader, several others, NinjaTrader, whatever. We have several charting softwares. What they do is they give you the charts so you can look. Let me go ahead and show you. These are the charts, right? These lines you see all around. This is what the charting software does. It helps you to be able to analyze, to know where you're looking to take a trade from. That's what the charting software does, okay? And then we said the next thing you need is a broker. We said a broker is that institution that allows you to be able to trade in the market. And how do they do this? They do this by giving you a price quote. They give you the bid and they give you the ask. And to do this, they charge you a spread, or some charge you commissions to be able to carry out this service. Your deposit is going to be going directly to your broker. It's not going to the charting software. When you make a deposit into your Forex trading account, it's going straight to your broker. And then your broker holds on to these funds and gives you a trade account to connect to your charting software. And whenever you place a trade on your charting software, your broker executes that trade. But in more recent times, more brokers have, native charting softwares on their platform. An example of that would be Hot Forex. Recently, they changed their name to HF Markets, right? This is not, I use HF Markets as well. Anyway, so these are some of the things we've talked about. And right now we'll be looking at how to set up your trade account. For this demonstration, I'm going to be using a company known as IC Markets, all right? that's the easy way to get your account set up and connected, and you get yourself ready to trade. So let's go ahead and put this into our MetaTrader 4 trading software. So I have MT for my mobile device. Okay, let me go ahead and do this. So to go ahead and do this, I have to connect your account to your trading software, your charting software. I have MT4 already downloaded on my mobile device. I'll go ahead and click on new account. Then I'll log into an existing account. Then I go ahead and select the server. Remember from our demonstration, we have IC Markets SC Demo 6. I'll go ahead and type that on my device. IC Markets Demo 6. Okay, IC Markets SC Demo 6, right? Then where you have login, you fill in this number over here. So that's 66594-778. Then where you have password, you go ahead and input that password as well. So we have V66, save password, and then you sign in. So once you're signed in, this is the screen you come across. You can see over here, price has been quoted. You have AUD, USD, Euro, USD, as the case may be. We have the different currency pairs quoted with the ask and the bid, you know, all written just beside them, all quoted together. You can see the spreads, these floating spreads, right? You can see the spread has moved from about 6 points to 7 points, as the case may be. Now with this, you are able to get involved in the market. So let's say, for instance, we have a $200 account set up already for this demonstration, and you want to trade GBP USD. You go ahead and you select GBP USD. Let's say you've done all your analysis on the charts already, and you believe that GBP USD is going to be selling, right? Let's say you believe that GBP USD is going to sell or buy, as the case may be. You go ahead and click trade. You select the lots you would like to utilize for this trading, the amount, the quantity you like to purchase. So let's say you're using a 0.02. You go ahead and click buy. Now for this demonstration, we're going to also use our stop loss and take profit. So what we have here, this was where we entered the trade. We didn't do any analysis, this is just for a demonstration, right? Let's say we are buying and we have our stop loss just placed here. I want to show you exactly how this works. So we're going to make our stop loss very tight. We'll also make our take profit tight. So what do we have? What do we have on the screen? We have our stop loss right here at 1.27002. Let's go ahead and modify that. We have 1.27002. How about our take profit? We have it at 1.27165. 1.27165. So when you input these parameters, your trade is set up. Now, if the market goes against us, it's going to hit our stop loss. If it goes in our favor, it's going to hit our take profit. As the case may be, you can see that while we are in the trade and making profits, we have the exact amount we are making displayed on our screen here. And if it's a loss, the same amount is going to be displayed on the screen here. So what we did was an instant execution, and price is approaching our take profits right now as we're trading. So as easy as this is, if you want to exit the market at this point, you are going to use an instant execution as well. You just come over here, you have close, modify, trade, chart. You click on close. And if you want, you can close a portion of your trade and leave a portion running. So since we bought 2 micro lots, we're going to close out 1 and leave 1 running. So I'll leave 1 with the instant execution, so you see exactly how it works. We close with profits, and we're going to leave the second portion now to either hit take profit or hit stop loss. And it's as simple as that. That's how you have your very own trade account set up, and you are able to get involved in the market right from the very first day. So before we end this video, let's take a quick recap of everything we've talked about. So we started by introducing you to what the forex markets are. We said forex is a short form for foreign exchange. It simply means foreign exchange. The markets where you make money by buying and selling currency pairs. holding on to a currency pair while the exchange rate, I beg your pardon, the exchange rate moves from one point to another, right? Then from there, we talked about some key players in the Forex market. To name a few, we said we have the speculators, we have hedge funds, we have central banks, sovereign wealth, mutual funds, whatever as the case may be. These are all participators in the Forex markets. And we said to start trading, you need to have a broker and you need to make use of a charting software. A charting software, we explained, is what gives you, all of this price you can see on your screen, so you are able to place a trade when you want to, right? And then we said your broker is where or whom, it's that institution which you make a deposit with and will provide you with the currency code, showing you the ask and the bid, right? Remember those terminologies, and you'll be able to get involved in the market because you've connected or you're registered with a broker. After that, the next thing we looked at was how you can create your own trade account. We said to create your trade account, you simply select a broker. For this demonstration, we made use of IC Markets. We created accounts, we walked through the process together, and you're going to have to provide some form of documentation to, verify your account, and then you'll be able to have a live account to trade with. So if you found value from this video, if you have any questions, you can leave your questions on the community, and we'll attend to them as soon as possible. And if there's anything you don't understand, you can watch this video again. And if you still have, few questions, you can drop them in the community, and then you're going to get a response to your question. Thank you for joining me. I'll see you in the next video.